Okay, so now that we've seen what top-down and bottom-up methods is about, we have also seen that both can be combined, but you may have a preference from one versus the other. In which case, what you need to know is which one to choose. Well, it depends on two things. The first thing is market conditions. As you see from the slides, basically, when markets trend sideways and there is a lot of sector rotation, i.e. it may happen that insurance companies perform well at some given stage of the business cycle, then it's banks, then it's automobile, then it's food, etc. So the performing sector changes quite often. Then stock pickers, or bottom-uppers, as we call them, win the race. That is obviously provided that they are good at picking those stocks. So here, in this case, we will be talking of a market of stocks rather than a stock market. Here, what you need is a lot of dispersion across sectors. Not all sectors move together. They have different returns and they are desynchronized. Or you need a lot of differences within each sector of the individual companies. And that's where the bottom-uppers will do better than the top-downers. Okay? Now, to the opposite, if there is low dispersion of individual stock returns within a given sector, it pays to emphasize asset allocation, i.e. the most important decision, and we will see that in a minute what we mean by that, is to be right on allocating a good share of your portfolio to equities, to the risky asset, and then make the decision to get out of this risky asset and increase the non-risky part of your portfolio, i.e. cash and bonds, or less risky in the case of bonds. So here the asset allocation decision matters more than the one of selecting individual securities. The other obviously factor that you need to take into consideration when you have to consider one versus the other is basically, I would say, it's two different fields, right? The top-down approach entails having a macroeconomic approach, a global approach. You look at the global economy, you look at the global picture, and you try to derive factors which will influence markets globally across countries, and then you take preferences on countries. The bottom-upper approach is more for someone who has a good knowledge and understanding of the corporate world. So it's macroeconomics versus microeconomics. Ideally, and that's the idea that of using a bank or using an asset manager, is that you will find people who do the top-down and you will find people who do the bottom-up. This is actually how a research department is set. When I was working at the private bank here in Geneva, I was the head of research. I was doing the macro, the global picture, but I had a team of about 15 analysts who were conducting the bottom-up part for making their stocks recommendations. When we look at top-down versus bottom-up, there's also a question of market risk. And I would say here the top-down method enables you to hedge the risk of your portfolio, in that if you fear that at some point markets will tumble, basically what you will do, as I pointed out earlier, is you will shift your allocation to equities, you will reduce it, and you will increase the one to the non-risky cash or less risky part of your portfolio, bonds. So here basically you can have a view with this top-down of managing not just the return part, but also the risk part of your portfolio. If you are focusing solely on bottom-up, then it's more difficult to also have a say on managing the risk of your portfolio. You can do so if you do not have the obligation to be, as we say, fully invested. More often than not, if you're running an equity fund, you are constrained to be, as we say, fully invested, i.e. you cannot hold more than, say, 10% of cash. So whether you like the market or not, you have to be in the boat. You have to remain invested. So even if you think that the whole market is too expensive, you have to stay invested. So that's a constraint. You can hedge the portfolio using a bottom-up approach if you can use derivatives, and we'll see in another MOOC what we mean by that, how you can hedge your portfolio by the use of options and futures. And also if you can do short selling, as we saw when we talked about hedge fund, their ability to sell short a company. So that enables you also to manage the risk of your portfolio. But all in all, I would say it's far easier to have a say also on managing the risk of your portfolio if you're using the top-down approach than if you're using the bottom-up. I recall, and this is the picture here I show you, of this sinking boat, which may certainly be familiar to you. I remember when I was working in this private bank and we had the analysts. This was right at the peak of the bull market in 2000, and the market started tumbling. And then the analysts come and say, ooh, technology is too risky here. I think we should move into more defensive stocks, like food and pharma, which are less sensitive. Obviously, they've been also less performing than all the technology, media, and telecom stocks in the late 90s. So we hit the peak of the market, NASDAQ more than 5,000, and then it tumbles. And so the analysts came and made new recommendations. So move out of these high-performing, high-octane technology, media, and telecom stocks, which had been delivering staggering returns, and tilt the portfolio into more defensive buckets like food, retail, pharma, and so forth. And I remember this partner of the bank, which once came to me and said, Michel, with your analysts coming each week and making new recommendations, either sector-wise or company-wise, it sounds to me like changing cabins in the Titanic. So what do we mean by that? Well, obviously, when you're in the Titanic, it's far better to be able to leave the boat than to be able to just change cabin within the sinking boat.